So in the backdrop of the uncertain global climate created by the conflict in West Asia, the focus remains on the Indian and global economy. What lies ahead? What are the headwinds that we will now face? Joining me now is one of the world's most distinguished economists, former Reserve Bank of India Governor, Professor of Finance at Chicago Booth, and also has been with the IMF in the past, Dr. Raghuram Rajan. Good to have you as always on the show. Thank you very much for joining me. I recall speaking to Dr. Rajan in March, soon after the conflict broke out in West Asia. And then you had said, if this conflict continues into the summer and beyond, then the world could be heading for a very grave situation. We're now in the month of June, and there is no end yet to the conflict. How do you see, therefore, all of this playing out in terms of the global economy and India's economic challenges?
Certainly what has happened is that this conflict has lasted way beyond what the initiators, Israel and America, thought would happen. And negotiations are also underway. I think there is some hope that a agreement will be reached. The hope is always in the next week, but every week we are disappointed. So it clearly is harder. There are some issues which it's very hard to bring the two parties together. Of course, this is not even talking about the nuclear issues, which early signs suggested would be postponed into the future. The world has actually managed better than one expected in the beginning. And that's because there have been all manner of adjustments. First, we have run down the buffers that existed, both the commercial buffers as well as the strategic buffers of oil and other forms of fuel. So that's one source of adjustment. Another has been kinds of substitution. Countries have moved towards using more coal, China as an example. We also have seen that in China, cars are not using gasoline anymore. They're using electricity. Of course, China has a big EV population, and that has taken some of the brunt off. In fact, if you look at oil production also, that has increased substantially in the United States, while oil consumption by China has fallen, in part because they're not filling their strategic reserves anymore, and a number of industries have moved away from high-priced oil to much lower-priced coal that they have. And I think such substitutions are taking place across the world. What is true is this room for maneuver is reducing. Ultimately, the fact that around 10% of world energy is shut out will play a part in slowing economies down because the buffers will run out. When the buffers run out is everybody's big question. Nobody quite knows when. But if we see this kind of impasse by the end of summer, almost surely we're looking at much slower growth in the world economy than we anticipated initially, partly because of the effects of oil shortages. And that too, it will affect India for a similar reason.
Let's come to India for a moment, because you mentioned oil shortages and the energy crisis. We're already slowly feeling the heat. There have been half a dozen hikes of fuel prices at different times in just the last month alone. And when you then speak to government's policymakers, they say, look, we're better off than the rest of the world. Compare the hike in fuel prices in India to what the hike in fuel prices have been in parts of the Western world, or indeed in our neighborhood. Do you go along with that argument? Is that a good enough argument to make that, look, we are no different to the rest of the world. In fact, we are better off, they say, than the rest of the world, even though we are a heavily oil import dependent economy?
Well, the reason the government can say that it hasn't passed through is because it's taking the hit on the fiscal. There is a limit to how much hit you can take on the fiscal without concerns of serious long-term damage being done via, for example, the higher debt that has to be issued, the need to finance that debt, the interest payments that will go out, and so on. Remember, we are trying to bring down the debt. We have a target. We're also trying to bring down the fiscal deficit. There is some leeway. The government is using that. But this is not a pleasant state of affairs where you're trying to cushion the blow from higher oil prices by either forcing the oil marketing companies to take it on their books, which ultimately is a hit to entities that are partly in the private sector, which you shouldn't be doing, and longer term, taking it on the government's sort of budget and balance sheet, which effectively is postponing the problem to future generations of Indians. We have so many needs for government spending, including schools, healthcare, and so on. And subsidizing, especially richer households who consume more oil by keeping the prices low is not the most sensible government policy if this continues into the medium term.
So what would you suggest, given as you're saying that there is pressure on the fiscal, that this cannot be sustainable for an extended period, and there is, as I said, no clear sign of when the Strait of Hormuz will open, when those oil flows will be back to what they were pre-war. What is the solution? Particularly, let's look at the energy crisis first. The government keeps talking about the fact that we are diversifying our basket, looking for other countries from which we can import oil. What is it that we really need to do in the short term over the next few months?
In the short run, almost surely we have to pass it on. Maybe not in one jhatka, but in steady sort of increases in the prices of all manner of energy, including gas and oil, petroleum, as well as diesel. So this has to be a steady process, and the longer it lasts, the more adjustment you will have made. You can't sort of wait and hope and pray that the strait opens up, because it may take longer than you think, given that on both sides of the bargaining table, you have some very, very strong and determined interests who may not give in that easily. So I would say a steady sort of process of raising the price to make it match the market eventually is what is important, because part of the adjustment to higher oil prices is lower demand. And it is important that if these prices stay higher, our industry, our restaurants, as well as our people, especially the richer ones who consume more of this stuff, adjust. Now, that doesn't mean that you can't find ways to help those at the bottom of the pyramid. You could still subsidize gas cylinders, for example, for those. But I would say, by and large, any kind of subsidy should be very targeted at this point. And we have methods of doing that targeting, but pass on the prices more generally.
Let's look at some of the headline numbers, Dr. Rajan. The figures that came out just a few days ago showed the Indian economy showing some resilience in FY 2026 with 7.7% GDP growth. The government said, look, this is a sign that the economy is far more resilient than many believe. The RBI, though, has cut its financial year 27 growth forecast to 6.6%, while raising CPI inflation, consumer price index inflation, to 5.1% against earlier projections of 4.6%. So are we going to see possibly the concern over inflation and the impact that could then have on purchasing power of consumers? That is the real challenge, isn't it? Because the Modi government has been very successful, reasonably successful over inflation in the past, but they now could face a fresh challenge. Is that, according to you, going to be one of the big challenges? How do you keep inflation under control?
It will be a challenge for sure, because inflation comes in through higher oil prices and then feeds through to almost everything else in the economy. What the government and the RBI will be watching is how much this is a one-time effect with higher oil prices feeding into prices of goods and services. As you said, given that the prices haven't been passed through so far, it's not surprising that inflation is a little calmer than it would be. But eventually, as you pass through, it is going to show up. The real question for the Reserve Bank will be, if these kinds of higher inflation, one-time higher inflation, starts prompting more of an inflationary spiral, that people start expecting higher inflation, and then it gets more out of control. Right now, projections are still that inflation will stay within the RBI's band, and it can, be a little calmer about raising interest rates and slowing the economy while that is the case. But it may not last forever, especially if this war lasts longer and prices move. Right now, today's oil price is $93 a barrel. This, if it goes to actually slow down demand, could be much higher. Some people say maybe $150 to $200. That is anybody's guess. But if it gets to those levels, then you're seeing both prices go up, but also expectations of prices going up go up, and that is the killer as far as inflation goes. When people sort of start believing inflation will be higher and make inflation actually higher because they themselves will demand higher wages, businesses will pass through higher prices. Now, the other issue, and this may seem strange given the high GDP numbers, is that there does seem to be, some spare capacity in the economy. I can't find other ways of explaining why investment by corporations is so tepid. If investment is so tepid and there is some spare capacity, it may well be that corporations themselves don't raise prices that quickly. So there may be another margin there for us, for India, to go slow on raising interest rates. That said, either one or the other has to be a little iffy. Either the GDP numbers don't reflect the true state of the economy, or corporations, for some reason, are overly pessimistic and are not investing. It's not clear how you can have an economy growing north of 7%, as the GDP numbers say, and corporate investment really so tepid.
Have you tried to, what is your view of that? As I said, the headline numbers showing the economy growing at 7.7%, slowing down, yes, and yet private investment not picking up. What could be the reason? Arvind Subramaniam the other day seemed to suggest that there is an element of fear factor that could exist, or a sense that cronyism has grown in the economy, and hence many others are not investing. The MSMEs, the smaller and micro enterprises, have taken a bit of a hit, is another view. What's your view? Why is it that investment is not picking up? If the headline number shows 7.7%, why is private investment, in your view, still not picking up?
I don't understand.
Or are the GDP numbers falsified?
Look, I think if it was growing at this rate, you would definitely expect investment to be higher. This was a puzzle 10 years ago. It still is a puzzle today. Why corporate investment hasn't taken off? And the only answer, with the kind of growth we've seen over the last 10 years in the official numbers, is that perhaps we are growing less strongly than those numbers suggest. But again, I don't know where the discrepancy is. Arvind Subramaniam, as you know, has pointed to a number of data points where growth is less than it should be, even while we are seeing very strong GDP growth. But I cannot fathom why corporate investment is not picking up, because with this kind of growth, you reach capacity, sooner. And one of the things you see in the capacity numbers that RBI
So do you trust the growth numbers?
Do
you trust the growth numbers? Sorry to intervene. Do you trust the growth numbers?
Let me put it this way, that something is off. And I have to believe that, you can't just attribute the lack of investment to fear. Our industrialists are fairly money-minded also. If they saw the opportunity in investing, they would. The fact that they're not investing suggests that, they're not seeing the kind of demand that would be consistent with these growth numbers, which suggest the growth numbers aren't fully reflective of what the economy is doing.
Can I move to an issue which, of course, you've written about in the past, the rupee? When we last spoke in March, it was about 93.4 to the dollar. It's gone up to 95.6. You also had, the depreciation of the rupee. Do you believe that, as one member of the Prime Minister's Economic Advisory Council says, there's nothing wrong if the rupee falls further, even goes below, above 100 to the dollar? Do you believe that there will come a time when that will stretch us, particularly on our forex reserves? Or do you believe it's okay to have a free fall?
Yeah. Steady adjustment is okay. A free fall is not. So, with our current account deficit larger, but more important, the fact that capital is not coming into India to the extent that we need to finance our deficit, the rupee adjustment, some of it is necessary. What you don't want is a situation where the rupee falls because people think it's going to fall, and you've got a lot of investors abandoning rupee assets because they fear a further fall in the rupee. That kind of free fall can be very damaging because it can take you far beyond what the reasonable value of the rupee should be. This was a situation we faced in 2013 with the taper tantrum, where the rupee plunged 25, a significant amount over the space of 2-3 months. And, there was a clear case for rescuing the rupee at that point because the free fall was unwarranted, which, as the rupee recovered its strength, that was certainly the case that perhaps it had been oversold. One could debate whether that's a reasonable place. We are in that kind of place today. I don't think we are. But nevertheless, what is worrisome is the fact that capital inflows are not coming in to the extent India needs. With all this talk about what a wonderful economy India is, the 7-point-something% growth that we saw in the year so far, it is not consistent with the kind of investment from foreigners also. FDI is down significantly. They're not bringing in money to build factories in India. And portfolio investment they've been selling and getting out, which is consistent with a lack of confidence in the Indian economy. Now, this may be, headlines. India is not positioned well for AI, which I think is a debatable question. And second, India is not benefiting from the China plus one strategy. We're still not a manufacturing power despite all the efforts of the government. But this set aside, I think part of the problem is nobody knows what India's vision is, other than it wants to be a developed country by 2047. What are you going to emphasize? What is the economic sources? What is the economic growth going to be? How much are you going to invest in your people? None of this is particularly clear, even while we have probably the strongest government, politically speaking, in decades. What is the government trying to do? What we had in the recent past is a bunch of, yeah. Go ahead.
Go ahead. No, please go ahead. Because, taking up from what you just said, Surjit Bhalla, former executive director at the IMF, was on my show a few weeks ago. He created a controversy by suggesting that while the Modi government was politically strong, it was at its economically weakest. And he argued that policy uncertainty, domestic structural bottlenecks were discouraging long-term capital formation. And that is why there was this sharp decline in net FDI. He said inconsistent taxation, regulatory unpredictability, compliance burdens, retrospective disputes. So obviously, it's not just the war, the conflict in West Asia that's obviously adding to the stress. But there is a need for, as you said, a clear vision, direction, and specifics to be addressed.
Absolutely. So the weaknesses in capital inflows into India predate the war. We've seen slower inflows for the last couple of years. Of course, the stock market reflects some of that. But the FDI numbers most clearly reflect. And that's consistent with the fact that Indian entrepreneurs are not investing, the point we talked about earlier. So both foreign investors as well as Indian investors aren't putting assets on the ground. That is suggestive that they see something that is not reflected in the headline GDP growth numbers. But to the point that what does India stand for economically speaking? I mean, this whole, make in India idea, yeah, it has had some successes. We've brought self-hold assembly into India. But the kind of growth that we expected, both in terms of manufacturing output growth, but also job creation, is much more tepid than India needs. I mean, you saw the Cockroach Janata Party take off, partly because we have millions of unemployed youth that we're not providing jobs for. What is the strategy to provide them jobs? And talking about 2047 is a little irrelevant when you're not describing the pathway to 2047. What are we going to do? And to your point, start first by reforming the kind of getting rid of some of the irritants that make it harder to invest. Now, what we had last week with the proposals on the, attracting foreign investment are important band-aids, but they are band-aids. They are ways to, bring in money, perhaps by liberalizing some of the frictions which kept the money out, but also providing a huge subsidy in terms of the foreign exchange swap that the RBI is providing. The question is, why do we still need to subsidize foreign investment if we had a strong growing economy which would attract that investment? And my worry is, yes, we'll get the money coming in, but we need to also accompany that with important reforms that actually make India a better place to do business and give people a sense of what the India narrative is. Is it going to be more services oriented? Is it going to be high-tech manufacturing? If so, do we have the necessary inputs such as stronger engineers? I told you a little bit about being back at my alma mater, IIT Delhi. And it needs massive resources to be competitive with some of the universities that China is producing. Our engineers are going to compete with Chinese engineers. They were better than what China was producing in the late 1990s and early 2000s. Now I have to say China has far better universities than India has at the top. We need to understand that we risk not investing in our human capital. If we don't invest in our human capital, we risk our future. But again, what you hear about is talk about freebies to win elections. The government was trying to stay away from freebies, but now it's fully participated in that. What is its strategy for long-term Indian growth? I don't see it.
Given what you've done, and you've given us a broad sweep, in conclusion, therefore, given that we are in these stress times, given that the war in the Gulf has aggravated the sense of trust, what is your economic outlook for the next 6 months? Is it that is there an opportunity that you see in this crisis, or do you believe that it will get worse before it gets better?
I think the pain will have to be borne. There is no two questions about it, because most of our pain is imported from the Middle East. If the Strait stays closed for much longer, towards the end of summer, I think we will have to absorb significant pain because we import so much of oil from that direction. But I think if it causes us to, experience a wake-up call that, maybe all this. This presentation of a wonderful economy doing so well, we need to re-examine and find out what is really going wrong. And I would say the lack of investment is a canary in the coal mine. It's telling us something is not quite right. Can we figure out how to liberalize the economy, reform it in such a way that we can propel investment? And that would mean also many more jobs to satisfy our hungry youth, many of whom legitimately now are saying, what is going wrong? I would say that we need to create those jobs. A rethink forced by more tighter circumstances would be very welcome. And there are so many ways we can move forward. But first, we need the willingness to acknowledge that something is going wrong.
I'm going to leave it there, Professor Rajan. As you said, first we need to acknowledge that something is going wrong. Thank you very much, in a way, for giving us that what you believe is a wake-up call for the Indian economy and giving us the big picture as you see it from your vantage point. Thanks very much for joining me on the show today.